right, determining your investment strategy. So there are several different investment strategies that you could use, and again, it's just going to depend on your inclination to take on risk or not, and the site, right? I mean, some sites are going to be perfect for the value add BRRRR strategy, whereas some are just better for land banking. So we'll walk through each of these real quick. So development and redevelopment. The development is where you completely re-envision what a property could be. And so that's saying, we're going to buy this raw piece of dirt and we're going to build an office park here. And here's the vision. You go through the planning. Sometimes you've got to go through rezoning, but that's development. Redevelopment is seeing a site that maybe it's currently an office building, but you're going to go in and you're going to completely turn it around into an apartment complex, or you're going to tear down that existing building and build a warehouse. So basically, you're taking something that's already been developed before and just changing what it is. I'm working on several of those projects now, mostly mixed use. I'm a big fan of mixed use. I think that's kind of the future of commercial real estate, especially in a post-COVID world. The value add or BRRRR strategy. BRRRR stands for buy, rehab, rent, refinance, and repeat. That's one of my favorites. It's probably my favorite strategy. It's the one that I've used the most out of any of these. It is where you go and you find a site. You do any renovations to it necessary to have a tenant see value in those renovations. So don't renovate it to comps. You just want to get the most rent possible. So don't overdo it. And then you rent it to a tenant. And then once it's rented, the beautiful thing about commercial real estate is that it's valued on a cap rate, not based on comps. So that property, by renting it, you've significantly increased the value. So now you can refinance based off that value, pull all of your cash back out. If not more, you may be able to do a cash out refi and then move on to the next property. So basically, you'll just be able to cash flow that asset, get all your money back, and go buy something else. So that's what I like about that one. I mean, you can kind of just keep snowballing cash. Land use value add. So this would basically be buying a piece of property that you believe is not at the highest and best use. So maybe it's a residential piece that's on a major thoroughfare and you think it should be commercial. What you would do is buy that asset, go through and renovate it. Rezone it. And then you would flip it to another developer. So, you've created a significant amount of value by rezoning it because now somebody else can come along and do something way bigger than what they could before. Let's see, land banking. Land banking is where you buy a piece of property that's in the path of development and path of growth, and you just kind of sit on it. You just wait for something to come along. We've got a couple of clients that do this. They just 1031 into large tracts of land that they believe are in the path of growth. And, 5-10 years later, the property has, 10x'd in value, and they'll sell it and do the same thing again. So it's called land banking because it's literally like treating it like a bank. You just place cash there and you just wait. Then there's the long-term buy and hold. So this is a pretty common strategy for like single tenant net leases. Like this would be where you go through and you just buy a Walgreens that has a 20-year lease and you just let it sit there and you just let it appreciate while you collect some money. And then there's owner occupied. So owner occupied is a strategy where maybe you own a business. Well, you can actually get better terms, just like if you're buying, residential property, you can get better terms since you will be the one occupying the space. Now the downside, you've got to occupy at least 51%, but I see that as an upside too. You could buy it, occupy 51%, rent 49% out to other tenants, and now you're kind of doing a house hack, what I like to call the commercial house hack. So, well, I guess we already kind of went through this. So, development, redevelopment, going through reimagining a site. Developers are really coordinating a whole lot of other people that are, throughout the entire process, right? The developer is essentially a project manager. They control, how we're going to do the lending, how we're going to do the construction, how we're going to do the management. I mean, they do every aspect. So, like I said, it's not always ground up, but it can be. I mean, it's ground up, and you could tear buildings down and redevelop the site too. Let's see, land use and entitlements. Those are very important. If you buy the wrong piece of property, if you buy a property that's not zoned for what you're trying to do with it, then you can get into a lot of trouble. That's how people lose a lot of money doing development. It's very easy to do because you're buying land that's not making any money. So again, the BRRRR, let's see. Oh, I mean, here's another thing. I like to buy these at well below replacement costs, right? So I recently did one. I'm probably going to do a case study on this. It was a 2-story office building, and I bought it for $81 a foot. Now, you could not build that office building back for $140 a foot. So what we did, we bought it at $81. I put $20 a foot into it in rehab, so we're $101 a foot all in on this BRRRR property. And guess what? I mean, I was able to bring it at well below market rates because everybody else was having to get a return on $140 a foot, whereas all I needed was $101 a foot. So that helps significantly. Again, highest and best use, you're typically going to be working with architects, engineers, land use attorneys to go through the design, rezoning, and any entitlements. This can take months, if not years, to do, depending on the size of the property. And then what most people will do is they flip it to another developer or an investor. Or what you could also do is you go through the rezoning and entitlement process, you make it worth significantly more than what you paid for it, and then you contribute that land as equity into another developer's project. So, you can also, we're doing this on a site where we're buying it for $2.8 million, and because of the value that we've created in it, we'll be investing it with another developer will be building on it, and they're valuing the land at $6 million. So we've created a significant amount of value there. Land banking. You could also do the strategy I just said with highest and best use on land banking. You can contribute it as equity into someone else's deal. This is one of the best things that I've seen people do because then you don't have to worry about 1031ing out of land and deal with all that because maybe you want to hold it, and maybe you find a developer that also wants to hold it. And so you contribute it, you'll develop it, you get 20% of their deal, and you make a significantly larger return on that investment. The long-term buy and hold, like I said, usually these are triple net. Now you do have a couple of options when you're buying these kinds of assets. Either you can pay down the debt and just, because like I said, if you're getting a 20-year Walgreens deal, maybe you do a 20-year amortization or 20-year term on your loan. It could be tough to find banks that are willing to do 20-year terms, but it's not impossible. I mean, we've got one bank that we work with that will do a 20-year term. It's basically 4 or 5-year arms. Or you'd have to refi it every 5 to 7 years. Just depends on kind of what you're looking to do. But yeah, you definitely take advantage of that long-term appreciation. I mean, think about it. If Walgreens is going to be occupying that space, it's a very good corner. Owner-occupied. So the thing with owner-occupied is after a year, you can actually move out, or however your loan terms are. It really depends on how you negotiate it. But after a little bit, you can actually refinance the property, put better debt on it, and move out, and then treat it as a 100% investment property. And then you can repeat that process. So then you go and buy another owner-occupied property, and now you've got 2 investment properties. That's a pretty good strategy for people who are just getting started that, again, own a business. Now, let's talk about underwriting the deal. So when underwriting a deal, the first thing that you've got to do is gather market data. As much data as you possibly can. So where do you do that? How do you do that? Well, CRS is a pretty good, that's a pretty good system for doing that. That's how we pull all of our comps, because I can go in there and I can see what's sold in the last 12, 18 months. And it, helps me understand, okay, well, something else that, had a 3,000 to 5,000 square foot office building on about an acre sold for X. So my property is probably worth Y. So that, that's pretty important there. I would talk to commercial real estate brokers. They're going to know what lease rates are and what's typical. You may be in a market where, all the tenants are used to full service leases, but you're a triple net investor. Well, if you're going into a new market where everybody wants full service leases, you can't really offer a triple net deal because, the tenants just won't get it. So yeah, when determining your lease rates and income, I highly recommend working with a broker or or a property management company that is actively managing properties very similar to that. Property managers are basically, they're like title attorneys. They're kind of the underworld of commercial real estate. They know everything that's going on because they're the ones collecting the rents and dealing with the tenants, right? So they could be a great option for you when you're looking for lease rates. Go ahead and estimate your expenses too. As a property management company, we kind of know what it costs to manage a certain asset. So again, maybe you lean on a property manager to kind of help you with that. But you got to take into account common area maintenance, property taxes, building insurance, everything down to what's Wi-Fi. Are you including Wi-Fi in your costs? Some of our properties have that, some don't. So, each side is very different. Now, should you do back of napkin versus, underwriting software? What makes sense for you? Well, I use kind of a back of napkin number whenever I'm buying or looking at buying and making an offer. And then if it passes the sniff test of, that back of napkin, then I'll go ahead and fully underwrite it because I've got an underwriting software. And I'll leave a link to my email below if you're interested in buying that. I'm actually going to do a video on how to use it here pretty soon. But, it gets really in depth. I mean, it shows you what your internal rates of return are in year 4 if the vacancy rates are X. I mean, it really, really goes into it. And so it's important, especially when you're raising capital and pitching to lenders, that they see that you've fully thought through what this is and not just, hey, I think it'll make 8% returns and we should buy it. So that's kind of how I look at it. Now, what back and napkin number do I use? Well, if I can get, an 8 cap or a 7 cap, typically about an 8 cap once it's stabilized, like I'll actually start looking into it